everyone. This is my first trip to Australia in quite a while, so we've been having a really good time. Glad to be here, and I'm looking forward to meeting up with Moritz and Richard and Adam and the other Moritz and Simon next week at our event, and so we're going to have a lot of fun there and seeing everyone and seeing more of Australia. I posted a picture today of this crazy one. I'm a hiker. I think I've done a couple hikes, but this one was just out of control. Um, three plus hours. Very well, I'd say dangerous, but a lot of rocks. And I had to be very careful. And my wife is very athletic, so I had to keep up. And so that's been interesting. I did a lot of hiking since I've been here. Oh yeah, and then we're at this place called Lizard Island, really fun spot, and right outside of our room on the beach here is a sign warning us about crocodiles. So that was pretty interesting. Was not expecting that, and evidently there's jellyfish as well. That I don't know anything about these jellyfish. They're kind of small. It's just a nightmare for I think 24 hours. Yeah, and then last week or the week before, when Rich was on with Niels, Niels was talking about the animals and wildlife that's here in Australia that is, I think people should be afraid of. And Rich wanted to downplay that. So, okay. Uh, Not so sure should be downplayed. It's a tough place. This is for the rough and tumble. Us Americans living a comfy life. I'm not sure if all of us are cut out for this. So we'll see if I can survive 2 weeks in Australia. Should be fun. Seriously, we're having a good time. Glad to be here. Pretty excited about next week. Yeah, Oleg, are you?
Oh, hi. Unfortunately, I'm not in Australia. Hi, Jerry. Hi, Richard. Hi, Moritz. Hi, Debonair. Hi, Joe. Hi, Josh. Hi, Marcel, and all the guys that I can see here. As always, very glad to be here and to see you. Hi, Billy Grow. So, unfortunately, I'm not in Australia, but I have heard a lot about this place. I have heard that it's the most dangerous continent for the people, for the humankind. I have heard this that there is a lot of reptiles, there are a lot of animals, maybe not even animals, but insects, snakes. So I think it's tough place, but it's beautiful place, and I have seen photos of Jerry. It's really beautiful place. I love beautiful places. I love beautiful, as you all know here. I love beautiful places. And I have heard that a lot of people in Australia like to live in a tent. I have heard this. This maybe it's national culture, the part of national culture. I have heard. I don't know, is it the truth or not, but I have heard this. So it's very interesting. If so, okay. As I have said, I'm always saying that I'm very happy to be here from all the places I am and all the circumstances, maybe all the weather circumstances. So this week I was doing my notes from the asset result, as I remember, podcast. Very interesting. It's all conversations with Jerry. It's very interesting. So, very interesting conversation with Jerry, and I have done my notes and I have published them yesterday. And for example, I liked when Jerry said we have a company in portfolio that sells the biggest producer of French fries and the biggest producer of eggs. So those are nice too because there is no French fries futures and there is no egg futures, and so you can kind to get both. You have a company that if something happens, it may really get a big trend, and it is kind a commodity related as well. So it's only uh, one of the notes I made, and I like all of them. And I like this idea that, for example, it's not so many commodities-based futures, not, but we have a lot of commodities-based stocks, and with huge trend potential. Of course, all the markets have the same expectation, and it's one of our main principles that all the markets have the same expectation. But it's really very great to have a lot of very different markets. Very different markets. French fries, really, it sounds great. French fries. And so on and so forth. There are a lot of different producing companies that are interesting. And I really like this. So let's get started. Very happy day. Was waiting as always. I mentioned that I'm starting to wait our spaces in Mondays, maybe, and it's something like I was waiting an event in my childhood. I think that I was waiting all the week when it will be, and so uh, from Monday every day I'm waiting our 24 and plus nothing spaces because it's one of the most important things for me. So let's get started.
Thanks, Oleg. You're really good. You're really funny. You are making me laugh. Richard, how are you?
G'day, Jerry. Not too bad. Look, you don't have to worry too much about those jellyfish or crocodiles, Jerry. Just watch out for those killer turtles. When they start grabbing hold of your ankles and start pulling you out of your resort, over the coral. That's what you got to worry about, Jerry. So don't worry about those other things. But those jellyfish, Jerry, I think they're called irukandjis. They're sort of like a relative of the sea wasp. They're pretty nasty up there where you are, but so Jerry's at Lizard Island, which is it's about 100 kilometres north of Cooktown, or about 200 kilometres north of Cairns. It's a pretty special spot. I remember in my early days where I did a bit of zoology, actually getting out to their research station up there, and it was a pretty spectacular place. So I'm very envious, Jerry. You're in a very nice part of the world, apart from those animals up there, but looking forward to tonight, and definitely looking forward to seeing you next week, Jerry. That's going to be great at the event, and spending a couple of days with you. That's going to be great. And I hope you have a great time over here.
Yeah, we're having a great time already. And the people here are so nice, and food is great. A lot of good food. It's just perfect. Couldn't be better. It's just great weather. It's kind of Florida-like weather as well, and everything's going really well. So, anyways, I don't know what you guys want to talk about, but one of the things that popped up, you may have seen it. I saw this. I thought, oh, I'm out. I'm kind of off kilter here with the time zone and everything. It's late here, but I got a second wind thanks to Oleg and Richard. They're making me laugh. So, but you may have seen this post by Corey Hofstein. I thought was somewhat interesting. He says that SocGen has decided to pull their CTA index from their website and data platforms, and they were going to charge an annual fee for access. So that's going to impact the replicators of the SocGen CTA index, according to Corey. And according to his post, it's $10,000 a year daily data. And of course, if that doesn't work, I guess they'll just eliminate it totally, possibly. So it's a little complication for those guys who specifically want to replicate the most popular CTA, managed futures CTA index. I guess they could try to replicate mutual funds. Abby has a mutual fund that has probably a lot of the SocGen probably try to replicate that. That'd be a good proxy, I guess. mutual funds have to give their daily performance. But the whole point is SocGen is the one that everybody teams as the index needs to be followed and replicated. So I don't know. I thought that was kind of an interesting post. Hello, Moritz.
Good. I'm back home at least until tomorrow, and then I'll head down to Asia, to Hong Kong, and then on to Sydney to meet up with you guys. Looking forward to that. But I'm doing fine. I noticed that the SocGen CTA index it's not entirely gone from the SocGen website. There's also, you can access it on the Barclay Hedge website, or at least you used to be able to access it there with daily data. But I guess what the replicators can do without paying the 10 grand, you can still go to the SocGen CTA website. I'm happy to share the link here if you guys want it. And when you click on historical data, you used to be able to download a CSV file or spreadsheet with daily historical data all the way back to the beginnings of the index. And they've changed that. They now only show, I think, the past 6 months, end of month data, no longer the daily data, and the last daily print. So if you're a replicator and you want to save the 10 grand, essentially all you need to do is write a script or hire an intern to go onto the website every day. Don't forget about it. And manually download the latest daily index print from the website. It's manual, but you can still get the data. I noticed it because I use this index as a benchmark for my own trading and in the fact sheets, so I'm aware of it. It's inconvenient, slightly annoying, but a bank is a bank. They wouldn't miss an opportunity to make an extra 10 grand or money from their clients wherever they can. So there you go. Other than that, really fine. I was a bit of on the trip around the Western Hemisphere, and some events happened there. But trading is steady as she goes. It's looking to be a good week this week. Last week was a bit down, but look, it's up and down really. Who cares?
By the way, Moritz, I really enjoyed your new series you've got with Niels. That was a great one you did, the first one. So, tell us a bit more about that.
So I did speak with Moritz van den Worm from Polar, and meanwhile, I guess you guys will really like that. I did have a conversation with Anand Chatia from Greenland, systematic commodity arbitrage trader. I think that was a really, really good conversation. It's probably going to be another month or so before that comes out, maybe even a bit longer. I'm not trying to overdo it. I want to have one of these a month, not weekly or too frequent, because then I run out of steam or run out of good questions, good topics. So one a month is good, but I pre-recorded that with Anand, and I have a feeling that you will like that because it had some real interesting technical elements on spread trading, which I think haven't been discussed on any podcast before. And that was also Anand's first ever podcast. Like, I asked him a couple of times to come on, and he always, like Moritz from Polar, politely declined because they didn't want to speak about what it is that they do on the air. So yeah, but with Moritz, great conversation. I mean, their trade really is location arbitrage in the grain markets between South Africa, Europe, and the US. I have a feeling that is their signature trade. They're very good at it. They have data about transportation costs, storage costs in different locations. In order to execute that trade, you need to have intraday pricing because Chicago corn is settled at a different time than South African maize. It's just, this is, I guess, one of the reasons why these things work is because the barrier of entry is just a little bit higher than, for the stuff that most, people do with, daily data, daily bars, running the system. I include myself in that. But when you want to do what they do, you have to go the extra mile and get intraday data, which is expensive or computationally intensive. You need to have the tech set up to make that work, and you need to really probably also have good brokerage relationships with some of the grain brokers in South Africa to get the liquidity. So I just find that very fascinating. It's not one of the things that I will add or look to even add to my system. I don't have any edge in these markets, but I like talking to these people that have these specialist type of trades, and the results speak for themselves.
Yeah, I'm like halfway through your podcast. I'm really fascinated by all of that, the South African commodities. So it's really good to hear your voice. You have a good voice, and you do a good job on the podcast. But if you veer off of trend following, it's going to be trouble. I'm not going to let you do that. I know you won't, anyways.
I'm
Trying to,
I'm
trying to
scared.
joke. Yeah,
No,
yeah,
exactly.
exactly. Be scared.
We'll come hunting you, Moritz.
Yeah. No, I don't think I need to cancel my flight yet. I'm firmly in the classic trend following camp. I do trade the South African markets as well. Some of them, not all. I trade white maize, not yellow maize. They have white maize and yellow maize, and I ran a little bit of a correlation analysis, and I thought that the yellow maize is more correlated to Chicago corn than the white maize, which is, as we've learned from Moritz, a different thing. They call it pop, which is a staple food. So I trade white maize. It's a little bit smaller than yellow maize, but probably get a little bit more diversification benefit. And I'm really small with my AUM, so I can get into these markets easily. And then I trade the sunflower seeds down there. Which, where else in the world do you get sunflower seeds, right? So, sounds pretty cool. And the only thing I do is trend following trading on these markets. That's it. One entry, one exit, one stop loss, a certain day breakout high. Very classic.
I listened to another podcast. It was video. Watched it. I don't know if anybody saw this one. I kind of recommend this. I mean, I liked it. It was Resolve, the Resolve guys, who I think are working with Corey, or they talk about return stacking as well. With I think is Joe Kelly, or I think that's his name, from Campbell. And it was an hour and 10 minutes, I think. It was really good. I'd seen him recently on a panel discussion, I think, with the guy from RCM, Jeff. But this was one, he was on as the only guest, and it was really insightful in the sense that it was very anti-classic trend following. Okay. I just thought he made some points in there that were interesting. I can't remember exactly what it was, but something like he said something like, we have to get rid of those fat tails. Yeah, yeah, exactly. And in order to increase the Sharp, which was what we're after, that's the sacrifice. You have to get rid of some of these fat tails. I think he said the word thin tails. So I was just like, okay, kind of sad.
Yeah, the volatility, as we've said many times, is the natural byproduct. And for us who understand it, it's not a penalty. It is an inconvenience fee every once in a while that you go through that volatility. But in return, we do have that reward and that outlier exposure in the tail. And when we have a tail event, it is usually a positive right-tailed event as per the trade distribution, because we're cutting the losing trades off. We're not allowing the trades to go into the left tail and really hurt us. By the way, one podcast, not too long, maybe half an hour or so, to which I listened and I liked it, is a podcast by JP Morgan, and they interviewed David Dennison, who is the co-founder and co-CIO of Florincord. And every time we hear about Florincord, it's usually Doug Grenning speaking about Florincord and what they do and how they've grown and all of that. It was interesting to hear it from a different person, a different voice. He's more the quantity type of guy, technical guy. Nothing really too new in there. Just, he kind of like phrased it a little bit different. The question I had is when I walked away or stopped listening to it is I really don't know if Florencourt trades, maybe you do, if they trade any of the, let's just in air quotes call them normal markets, our markets, the stuff that we trade, whatever, corn, wheat, soybeans, or are they really only, are they chopping these markets off and they're 100% focused on stuff that is not necessarily in a CTA's portfolio, like the Kenyan shilling and Hungarian power and all the, whatever, Chinese markets, the things that I don't trade. Would you know? I mean, are they 100% on just the new stuff, or because then that to me is kind of like I wouldn't really understand that. I think add all the markets, fine, but there's just no reason to drop the existing markets that we have in our portfolios. I mean, if anything, keep them and just make it better by adding more. But not take off the stuff that we trade that has worked for the past 30, 40 years and replace it completely with the new markets.
Well, I've listened to him quite a bit, and he was, I would be myself if I've missed any of his podcasts, but I'm sure I have. But he was very forthcoming with his, well, at least I know the CTA series that Niels did. So there was a lot of good stuff there. And I've read a lot of his stuff and interviews that he's had. And he has definitely said more than once that, excuse me, they don't trade the normal markets. They only trade exotic. And so no US, no CME, no ICE, no Europe that we all trade. And now just one caveat to that, I think, is that ironically, he did say that they would trade, he would put, specifically, I think he mentioned putting South Africa, those those three markets in South Africa, altive, bucket. So now I think now I can't really say too much about, I don't like that they vol manage and correlation manage, of course, they all do that. But he talked about, and he's the one, who talked about this idea that every single time there's when the market makes a high, for instance, it's a reversal. When the market reverses, it's always a big blast of volatility. Yeah, I mean, we talked about, I think I can't really say too much. I can't really criticize their 500 markets. He goes on to say, we trade 500. It'll probably be 550 next year, 600 after that. And so it's just shocking and amazing they can get all these markets. But he did talk a lot about swaps and counter and not countries that have bonds that I've never heard of before, Turkish bonds or whatever bonds, So, but okay, I'm getting to my point here. My point is, and I don't want to be critical, but it seems pretty not obvious, but it seems like it could be a huge marketing thing. So yeah, I try to nuance it. I try to be nice. I try not to. I can't really do it. So yeah, and see, it fits in with the marketing because what's better than trading 500 markets and getting all these over the counter and really small commodity markets that are hard to get at? Well, don't trade anything else. Oh my God, you're like a genius. How can you do this? How can you find 500 markets and you don't trade the 100 that everyone trades, or the one something, 150 or 100? Wow, what a guy. And one of the things we talked about, because I tweeted the hell out of that episode with Niels, was he basically says, one of the things that is our edge in trading is finding these markets and doing the hard work and the paperwork and the agreements to trade these markets. He says we find them and we just are relentless on doing what it takes to put them in a portfolio. So I was like, that's good. I give you high marks, A+ for that, because that's a bonus. And of course they have a office, or maybe the only office now, or one of their offices is in Middle East, Abu Dhabi, I think. So I really like that firm. I love the 500. I've looked at their 13F, and there's not a lot of in their portfolio that was too impressive. I don't remember how many there were. I think there was just a lot of ETFs.
I agree. I think it does have a marketing touch to it. These guys are good quants. This Dr. David Dennison is a probably magnificent quant mathematician. He speaks about PCAs, principal components, and he clearly knows that if he added some of our normal markets to the mix, he'd probably have a better experience. But from a kind of like business and marketing perspective, it just sounds extremely cool to say, you know what, you already have all these other markets in your portfolio, dear client, in some way, shape, or form, be that through a CTA or through your whatever 40 Act mutual fund that you buy. And if things go wrong in the world, then you're exposed to these markets. And we just, give you a product that has nothing to do with them. It'll be completely separate from that stuff and therefore really uncorrelated. So I guess this is, when you think about starting a new business, hedge fund business, it's always the question that you're being asked is like, what can you bring to the table that's different? What's your edge? How cool is it? What do you do? What's your alpha? Like all these, you need to have some answers. I mean, I'm in that position now. You need to have some answers to that without, you can't, don't lie and make stuff up. I mean, you need to have, some solid arguments, but obviously they've had a killer arguments like, we're trading all these markets, we're doing the work. Oh, by the way, I should say that we have a little thing going for us here with the classic trend following stuff, because when I was traveling the last 2 weeks, I tried meeting Paul Mulvaney in London, but he unfortunately didn't have time that day. And then I flew on to New York and I met a couple of clients. And, I said, as we have said on this spaces, there's a handful of people probably in the world. We can't prove it, but let's say it's a handful of people left standing, classic trend following, one entry, one exit, one stop loss, nothing else really. And that's Jerry, Richard, Moritz, and Paul. Maybe a bunch of other people, but let's just say it's a handful of people. So I've mentioned that in a meeting. I can't mention the client name. Jerry, I'll tell you next week. You know him. He goes like, yeah, I've heard about you guys. So he's somehow listened to one of our spaces or listened to a replay. They're following us now. It's our marketing thing.
That's right. Yeah. Oh, yeah. We and we need to remind them why. You can't. We've got to just keep reminding too. In the midst of explaining, this is not some sort of. There's a great reasons why we do it the way we do it. Okay, one other thing I forgot about foreign court was another thing that he tries to do. Yeah, we talked about this months and months ago. And Moritz, you were on to some sort of research, or Bruno was. You and Bruno, or just Bruno? Because another marketing thing that they say that Doug said was that these are superior markets. Yeah. Oh, yeah. They're superior. So we can't sully our portfolio with all the ones y'all trade. They're expired. They're no good any longer because you're all there. And we're not there. We're somewhere else. And that's where everybody needs to be. Of course, you can't get there. And so these are just inherently superior markets. And I think Bruno did some research on that. I don't remember. I'm drawing a blank, but and that sort of goes to the heart of one of the trend following principles is that all the markets can have these outlier trends and trades. I posted an article in the Financial Times, just something kind of an editorial that they wrote about themselves primarily, I guess, but basically saying that all markets trend. Richard believes that. I believe that. I think it's kind of a fundamental principle that, in fact, I shared my idea that it's better to, in order, if you're going to trade stocks, trade smaller stocks because you'll get better outliers and they're smaller and they're not as diversified like an index. And lo and behold, Eli Lilly makes 600 ATRs on this particular trade, and it's one of the worst. So, don't listen to me because, that's a huge trade. Tesla, huge trade, two very large companies. And Moritz, if you would somehow send me that link to J.P. Morgan, I would appreciate it.
Yeah, I'll send it. I'll. Do you want me to put it in the Twitter notes here, or just email? I can put it in the. I'll tweet it. It's easier.
Well, I don't know. You guys should speak up, Rich, if you have something you want to get into and talk about. There was one thing that I've been really distracted with this vacation, and but I did see this one tweet from Absolute, who's not on tonight, but I didn't really know what he's getting at. I thought it was a good thing to discuss, but it was the rebalancing. The rebalancing tweet. I know he's trying to drag us into.
He's trying to rile us up, Jerry.
Yeah. He's trying to finally, get us to all of. Nonetheless, I thought that one tweet about rebalancing. I think what's great about what I do, which is 100% trend following, 100% diversified, diversification trend following, is at every opportunity I get. This is maybe not even on the right subject that he was wanting us to focus on, but every opportunity I get, I never rebalance. Never. Like if a certain system does all one of my four systems, I don't acknowledge that it's doing better. I don't acknowledge that I need to rebalance. I'm always trading all the systems with the same position size and risk. The markets, So if you're doing something you shouldn't be doing, which is trading something other than trend following, of course, maybe this rebalancing crap comes into play. Now, I guess as we've talked about millions of times, we do kind of have to, I have to every now and then rebalance my trade level that's highly correlated to the closed trade, realized trade equity. But other than that, I'm never allowing markets to be overweighted due to their profitability or underweighted or systems. And I'm never putting myself in a situation where I sort of need to rebalance internally in a trend following system. I guess if I had something outside of the system, like return stacking with stocks, some of them long, some S&P, and here's this plus the CTA trend following. Yeah, I guess you'd have to face that. I'm not really sure the right thing to do on that, though.
Yeah, Jerry. So look, the rebalancing principle is commonly used in index instruction, and it's also used by a lot of allocators when they're allocating to various funds. But when you consider our method, we are actually rebalancing, but we're rebalancing at the entry of our trades. So when even though we don't explicitly say that we're rebalancing, that's effectively what we're doing when we are treating all trades with the same risk allocation on entry. We're rebalancing every time a trade is over. The difference with these other methods is that they're rebalancing, say, on monthly, 6 monthly, periodic timeframes. And that sort of compromises our ability to capture these outliers, because if you are rebalancing when you're in the middle of an outlier, you're going to be reallocating capital away from that outlier to the rest of the portfolio. And we've had that conversation a lot with Absolute, that we don't do that. We commit to an individual return stream. And we stick with it for the long term. And when the trade is over, we do a rebalancing exercise where we're then saying, what is our realized equity at that point in time? And then any trade that we take at entry is rebalanced equally in terms of trade risk. But that is only at the entry. So then when we do catch some outliers in that sequence of trades, we stick with those outliers. And that means that we can get significant concentrated risk when we're in an outlier, but that risk is beneficial risk. It's not left tail risk, as Moritz was saying. That's right tail risk, which is good for us. And we're prepared to, hit the big baseball bat on those trades using unrealized equity as the basis to risk on that particular outlier. And so we've been through that many, many times over the course of time on spaces. So yes, we do, even though we don't explicitly say we rebalance, we are rebalancing at the beginning or entry of our trades, but we are not periodically rebalancing like allocators do or equity index constructors do, because if you do that, you will be necessarily taking away from your most profitable trades and reallocating to the rest of the portfolio, which is, not what we do when we say we let profits run.
Yeah, that's right. We don't do that. And we would have an opportunity to vol manage and correlation manage when the fat tails happen and the big trends happen and those trades, those few percentage of our trades are making all the money and driving the volatility and really misbehaving. The ATR is multiple times higher, and we're thankful for that. Whereas the 99% of the CTAs in the managed futures field have to find a way around that, which reminds me a little bit of what I was trying to get across to Niels last week when he was saying to you, "Hey, Rich, you're not treating these trades equal. Letting trades get too big or too volatile," and that's our whole point is we treat things with the same rules, and the quality of outcome is something we don't care about. They're going to do by following these rules, and these rules are loose enough to allow the trades to really get out of control and really, at some point, dominate the portfolio. What do you think, Alp? You made some comments to Absolute's tweet.
Hey,
Post,
Jerry.
I think I heard the other day. It's called Post now. No more tweets.
Oh, yes. Hi, guys. It has been an interesting week. I mean, I was just, listening you in terms of this conversation that you were having with Flooring Courts. I mean, there are, I guess, this year in my portfolio, the crypto segment is the most profitable segment. Okay, so this, fortunately, yesterday one of the cryptos like Ethereum has just increased like 10%, right? So I hope you're trading Ether futures in your portfolio. There's enough liquidity, not it is easily accessible, and the same thing applies to the Bitcoin as well. So I'm always keeping what Jerry Parker says in terms of every market has the same expectation, but it's clearly not, isn't it? If the market is new, like crypto, for instance, crypto is a new market. So if you look into the returns of the Bitcoin and Ethereum since 2018, I guess the point where I have added those to I have added the Bitcoin into my back tests, the returns are really great. When I do some calculations about measuring the signal to noise ratio, is the mathematical expectation there in Bitcoin and in Ethereum is really, really high. And I also do trade the other smaller cryptos as well at the moment. So there are some benefits in trading.
Alp, are you normalizing at all, or you're not normalizing?
Normalizing what, Richard?
So when you're trading your cryptocurrencies, are you normalizing them in terms of their volatility to other markets like bonds, commodities, etc., to allocate the same level of dollar risk to them, or are you not normalizing? If you're not normalizing, I can understand why their volatility is different. But if you are normalizing, I'm just wondering. Yes, we have had a good ride in Bitcoin, but I don't necessarily see that it is a standout in relation to, say, some of the commodities like orange juice, cocoa, those sort of things.
No. I do have a usual classic system. So I take the dollar risk and divide it by an ATR. multiple, um, and then come up with the position size. So as simple as that. But of course, so there are two observations. First, the mathematical expectation that I get in my back tests from crypto is higher, number one. So if you're not trading crypto, that's very interesting. Number two, there are smaller crypto markets as well, and that becomes a little bit based on the choice as a trader. You would like to keep it based on the futures contracts, okay, just because Bitcoin and Ethereum is proper, they are quoted in US exchanges now, so they are liquid, they are in the legal system and whatnot. And the others are very expensive to trade. Like, if you're gonna trade like Bitcoin Cash, Litecoin, and whole bunch of coins. So there's an index, Crypto 10 index, okay, and within that index, you that Crypto 10 index is like mainly the USD basket, the USD index, right? The USD index has the usual, the pound dollar, the euro dollar, the Swiss franc dollar, and that Crypto 10 index is the version for it, and you will see the most liquid cryptos there. But the problem is they charge like more than 20% if you want to trade it. That the annual charge is more than 20% because there are no features for the other one. So because I'm a short-term trader, that works fine with me. I really don't mind holding these other smaller cryptocurrencies for a couple of weeks, and I can get by. And I always thought maybe that's the reason why long-term traders wouldn't really necessarily interested in trading Litecoin. It's just holding it for a year or two or three or four is just going to be from 20%, 25% interest. It's just going to be not feasible to trade it. So you can only trade the ones that are giving you the futures, but still the exposure is there, is really making a huge difference. I guess I bought around 30K like a couple of weeks ago. Now it is 36K. The same applies to the Ethereum. So it's a huge opportunity there. With the caveat that I have mentioned, the futures. If you're worried about the costs, then the future ones are really profitable, and the costs are much less, of course. The other thing that the Jerry Parker has mentioned is these Turkish bonds. I'm from Turkey. Everyone trades Turkish bonds. Who doesn't? And it appears to be that when I come to London and when I'm talking to my US friends, you don't trade Turkish bonds. That's very interesting. How don't you just the emerging market exposure in the portfolio is a very obvious one if you're coming from an emerging market background like myself. The South Africa exposure that the Moritz was talking about is obvious. There are lots of good products in South Africa to trade. The same applies to Turkey. The same applies to India. The same applies to Mexico. South America, other countries. So China, Hong Kong, Taiwan, Asia. I mean, really, the only reason why I am not adding the emerging markets there, like the Korean bonds. Are you not trading Korean bonds, the Turkish bonds, the Russian bonds? They're really, really profitable stuff. Just the excess, it is really, my broker doesn't provide the Korean bonds, the Turkish bonds, but I'm Turkish, so I know they are very profitable. I lived in my own, back home in Istanbul, and many people trade Turkish bonds. They are very profitable, and surely you can catch outliers with them. It's just what happens is the brokers, like the benchmark broker I always talk about it, is the interactive brokers in the quant trading, and it's sometimes you're just limited with what the interactive brokers can give it to you, and that's the kind of limitation there. So you can only trade what your broker gives gives it to you, because that's the, you trade it with mathematical models and whatnot, and to be able to add other emerging markets. Once you identify the market to trade, it's a lot of work to be able to add it into the portfolio. So there's a lot of administrative work that needs to happen, and that's why I don't trade Turkish bonds. But I would highly recommend adding emerging market exposure. Is definitely a further diversifier. And finally, the what absolute posted absolute is yes. I agree with Richard. He's just trying to turn us all in back to his followers, and wall managed, correlation managed. He's absolute is wall managing, but I'm not quite sure he's correlation managing. Because he never posts about correlation management, but he's big on dynamic position sizing and why it is important. And clearly, dynamic position sizing, I cannot imagine increasing my number of trades, for instance. I'm a short-term trader. I already have a lot of trades, way more than the long-term traders. And if I am going to even increase this thing, it's just good business for brokers. It's not good business for me when I divide my outliers into 2 or 3. It's just not going to be the more profitable for me, but it's just going to be more profitable for the broker. I don't think it makes business sense. Thanks a lot, guys.
Yeah, well, I need to, sounds like I need to hire out to go out and find all these markets for me. They're so easy. They're out there. Believe me, we want those markets, but it's like I said, I think that's what foreign court really does well, is they find them, they search them, and no matter how hard it's going to be, if it's liquid, if it's something that's going to add value to the portfolio, they're going to do whatever it takes to get that agreement signed or get the lawyers and stuff involved. So it's pretty cool. I admire them for doing that. And the rest of us are just, if our local FCM doesn't carry it, or stock account can't get it at IB, or the stock broker we use, then I guess we're on to something else. But it's a full-time job to to source that, get the liquidity, get it all set up to trade. Another thing that I was interested in this week, I was really interested in this, very interested. It was this new book that came out. Fun. It's a book about Ray Dalio. I think this is just fantastic. I can't really put this book down. It's such a fun read. It's such a disaster company, but very successful. And I read a lot or some of the articles about the book that the author actually wrote before the book came out, and one of them I posted was Dalio. Him sort of giving the impression that Dalio's approach was trend following, and the futures of the book I've read so far, there is a little bit of his background that he was sort of into not fundamentals but charting, and but okay, so I think they have obviously a good track record in sort of equities and bonds. But one of the things that I found was very interesting in this book is that he really was great at selling and finding the clients and meeting the clients' needs and talking to the clients. And I think that is such a, such an edge when you, I think, you just can't sit there. My experience has been, no matter what the performance is, you just can't sit there without putting resources and time and energy into finding clients and taking care of clients and building these relationships. And he's really good at that. And then he had good performance. Oh, yeah. And the firm was doing really well because what did he call it? 2008 to some degree. he's very adept at making kind of predictions of what was going to happen, but very but predictions where almost anything could come true, and it would look like he was correct. But I think he kind of did get the 2008 pretty good, and that helped him a lot. And according to the book, multiple years in a row, assets were doubling, 50 billion, 100 billion, on and on. So, really good book. But I can't wait to get to the heart of it. If there's any more evidence that he's kind of a trend follower. But the way he ran the company, it's kind of a disaster, I think.
Well, I just ordered it. I'm rereading Fight Club, so I need to get something a little more intellectually stimulating. It sounds awesome. I last time I was on here, I just wanted to say something real quick. We were Jerry. I think you were talking to whatever that gentleman's name was. He was pretty intense about sort of your stock selection, methodology for your ETF. I wanted to ask Moritz, because I know in sort of your combined strategy where you're actually, and I know this is going kind of off the sort of the Bible here of just trend following, but I know you're kind of using making plays in spread markets as well. It's kind of just interested in kind of understanding what traits you're looking at. Is it similar to the sorts of things that maybe Jerry took into consideration in picking single stock names, or was it a quantitative process there? Just kind of curious about your thoughts on that.
Just real quick, pretty much the same thing. Calendar spreads, not cross-market spreads. I didn't get any of the synthetic combinations to work that are cross-market or very kind of like separate from one another. And then I look at many different calendar spread permutations. I mean, there's many available. When you look at the crude oil curve, for instance, right, you can create more than
You're okay. I got you. It's just strictly calendar spreads. I
Yes.
misunderstood the literature then.
Yeah, and I'd like to be long the calendar spreads that go up in price and short the ones that go down in price. That is, in a nutshell, the backbone.
Got it. And then this final question for me: how? I mean, I know that the data sample is far from significant at this point, but how have you found sort of that sort of delta replacement, option-based delta replacement exposure? I know that's sort of done discretionarily. Am I wrong in saying that? And how has that worked thus far?
No, you're not wrong. So I give you one example with crude, where I actually just done one of these trades. So say you're long crude, and I am long crude. I'm long Brent, and I'm long WTI. I'm long the entire petroleum sector, to be honest. So this is a big cluster in the same way that being short the bonds is a big cluster. And then about 3 months or so ago, I remember the crude oil curve was in contango. So further dated futures prices higher than new dated futures prices, and that has changed. The curve is now in backwardation. It actually flipped into a relatively significant backwardation. So now the back end of the curve trades depressed relative to the front end of the curve. And so what that enticed me to do is to take some of the delta that I have at the front through futures contracts, which are a delta one position. They are linear with respect to price, and it's a very punchy delta at the front end of the curve, right? Because that's where most of the beta is. If things happen in the world, the conflict in Israel, all of these things, you see the movement, or the largest move usually at the front end of the curve. That is where the music's playing. And the back end of the curve is more stable. There's a reason for that. I mean, these are commodities. At some point, physics take over. These contracts have a clock on them, essentially. When crude goes into last trade or first notice, all the forecasting stops, reality takes over. You either make delivery or take delivery of crude oil in Cushing, Oklahoma, at the price that is set right then and there. There's no longer any forecasting necessary, but the market is continuously trying to find out, or almost continuously trying to find out, what the best price for, say, Deck 24 or Deck 25 crude oil is.
Right.
And it's all just forecasting. And that forecasting is more kind of like stable, like, expectations on future storage and all these type of things. So, but back to the trade, I can take some of the punchy delta off and replace it with, say I'm taking 2 lots off, right, just for argument's sake, for ease of calculation. And I'm replacing that with a long position and 8 call options, which each have a 0.25 delta. That is the same 2 delta, right? Because 8 times 0.25 is delta 2.
Mm-hmm.
So I have the same delta on, but a bunch of things importantly have changed. First of all, my combined position is now no longer strictly linear. It now does have positive convexity or non-linearity to it. I transformed or replaced, hence the name, delta replaced some of the delta from linear to nonlinear space. And 3 things can happen now. Either crude goes higher, which right now it doesn't do. Maybe it's going to do it soon again, but right now it doesn't. But let's just say it goes to 150. Nobody of us can forecast that, and we don't even try. But let's say that's the case. Then the 8 call options, which I purchased in my example, they no longer have 0.25 delta. They're very close to 1 delta at that point because they're far in the money. And so then my total delta is, I had 10 futures lots, say, I replaced 2, so I left with 8 futures. I now have essentially another 8 delta through the call options, so my total delta is 16. It used to be 10. And back to the what we called the outliers and the positive tail. So I moved from 10 to 16, 1.6x or 60 times greater on a positive outlier move where I can really hit the ball out of the park. That is really what I'm trying to do here, is to get these, when we get into these tails, to really, I think Druckenmiller would call it going for the jugular, to make the most out of it, but not in a reckless way. The other scenario is crude does nothing. It just sits around, chopping around up and down. If that's the case, then, the futures don't care about that. They just sit there. These long-dated call options, Deck 24, which I purchased, they will react to that possibly a little bit. It's essentially a position on implied volatility and interest rates. So Vega and Rho will have the largest influence here because the option is still relatively long dated, 18 months on the clock, something like that. It's not very curved. It's not very gamma sensitive. And what I like about that trade is that from a theta or time decay perspective, because the curve is now in backwardation, my call option is actually going to be rolling up in time, the futures curve, right? It moves from the forward price, which is lower, into liquidity or into the present point in time, which is a higher price, and therefore I will be able to carry that option very positively without bleeding too much of an option premium. And then I'll stop. Even like as important as the positive convexity to the upside and getting into that outlier tail is the behavior in the adverse scenario, which we always have to have in mind, which is crude goes down. That is actually what happened. It's not at my exit level, but at some point, maybe if crude goes down further, it'll hit the systematic exit, and then the remaining 8 futures lots, which I'm using here in my example, they will have to go because that's what the system tells me. It tells me, Moritz, we no longer have any business being long crude at the moment. We're no longer friends. Maybe in the future we will be friends again, but for now it's time to go separate ways. And so when we say my exit, just for argument's sake, is at 60, so we can make the calculation easy. And let's also say that we're at 80 today with crude at the front. Then every contract will lose $20,000 on the way from 80 to 60. But as you know, mathematically, with the option premium, I'm also positively convex to the downside. So by definition, I will lose less than 20 grand per contract, or per contract equivalent in options on the way from 80 to 60. So that means I'll also have a better experience to to the way of my to the exit level. So this is usually what I'm trying to do. It's not always possible, and this is also why this is only about 5% or so of the trading activity that I do, because I'm very picky about these things. I want to be very greedy with these options. I know that the system works without them. This is what I love about it. It's like I have this engine room, kind of like on a big sailing ship. Like, it can go without the options. It absolutely goes from A to B without the cherry on top. And I can't do it in every market, and I don't want to do it in every market, and I don't want to do it in every situation. But when the markets in this crude example, it goes from contango to backwardation. It makes that trade just very attractive from a carry and time decay perspective. Also from an implied volatility perspective, it was attractive. It's a good fit for my portfolio at that point in time because I had this clustered exposure in the petroleum sector, still have it. And that's when I love to move some of the exposure, not all, only partially, into that nonlinear space where I think I can have a better experience, and also, well, hopefully, make use of my experience as an options trader for many years. I mean, I don't know, traded hundreds of thousands of these contracts in my life, and that doesn't mean I get it right all the time. I obviously do get it wrong, but
I'm sure it improves your chances.
Yes, but I also need to be fair to myself, investors, everybody. Like, every trade is flagged and labeled and put into a bucket, which is a discretionary option trade, and I, do the sum total on that stuff every month, every quarter, every year, and if it doesn't make money, then I maybe at some point should stop doing it. But for now, I've made money with that every year. It's not like I'm not adding 10% or anything to the experience, but 10 basis points, 15 basis points in a month, I lose 7 basis points, make 30 basis points a month. But that stuff compounds.
It compounds over time. Yep.
Yeah.
I mean, I you guys are, it's pretty cool that we get to talk to you and Jerry and the mad scientist, Rich. You're coming up with, these new sort of wrinkles on how to actually get kind of more pure, the spirit, the ethos of the CTA methodology, and you're actually implementing it in a cost effective way. I think it's freaking awesome. So thank you for that.
And Moritz, to clarify too, you do not mix, like, say, for grains, old crop, new crop. You stay in the active current crop, correct?
You mean with the options or with the futures contract?
Well, I thought with respect to your, and I may be mistaken, but I was thinking it was the options that you were talking about. It was when you were on the RCM podcast. I thought you had stated that, and in our podcast here as well, or our talk. Did I misunderstand?
No, maybe some of it, but you're also right. I did say that. So when I do trade the calendar spreads, that is important for me to recognize. I don't want to get into seasonal spreads for no reason. I'll give you an example. If you look, for instance, at the summer-winter or winter-summer gas spread, natural gas Henry Hub, March-April, when you look at the data historically and how that spread behaves, like 9 times out of 10, your system will tell you sell that spread. Sell it all the time, because 90% of the time you are rewarded for taking a massive risk of there being cold weather in March, or running out of storage, or storage being low. I don't want that. That is exactly the opposite skew and risk behavior that we all subscribe to with our trend following trades, where we keep losses small and we let the upside open. This is a trade that would have the downside wide open, because a risk event can occur, and you can essentially, like in a carry trade, only make a little bit of money. So this is why when I do these calendar spreads, I don't allow them to cross seasons. Your system would tell you essentially all the time to sell, Septec wheat, but this is a winter wheat, and I don't like these trades. So the way I do it is that the spreads, they need to be in the same season, or the same crop cycle in order to have a like-for-like comparison and not get into these trades. That is what I mean with that. That is what I said, and that is true. And then with the options, it really depends. Like I would never have an option trade in my portfolio that has no linkage to an existing futures position. That just doesn't exist. I'm not trading naked options, neither long nor short, but absolutely never short. So these trades only happen with respect to an existing position, and only usually in scenarios where I have a specific risk in a certain market. I like doing these trades when I already sit on open trade equity. As we've said many times, we like, at least I psychologically like to separate, I think Jerry and Richard as well, psychologically separate open trade equity from closed trade equity. It does help. Open trade equity is the money that the market has given to me because my trade was right. It's variation margin showing up in my brokerage account as positive P&L. It's a zero-sum game. If I'm long a futures contract, somebody else is short. If I make money, somebody else loses money. So I got somebody else's money, other people's money. I know we used this silly casino analogy, but it is like that. We'd be going to the MGM Grand playing blackjack all night long with somebody else's money. So I do allow myself, and it does help, to be more liberal in my attitude with that money, not close out the trades, not rebalance, just go with it until the exit is selected. And that then also allows me to be more interested in these delta replacement trades. I'm already ahead. This is going to be a good trade. This is going to be nice. So I'm essentially trying to find ways to really, amplify the exposure even more. Some people would call that, when they add to it, pyramiding. I'm not looking to really pyramid into a trade, like adding to it. I'm trying to partially transform it from that linear exposure that I have into something that can be, or will then be, partially nonlinear and positively convex and give me more bang for the buck. That's the objective, at least. But I need to implement it differently with every market. Right now, I'm not trading any cash options. I don't have Interactive Brokers or any of these firms connected. I'm really only working with one FCM. I can only trade futures or clear futures and futures options. So for Crude, as I've said, this is not a problem. Crude has a very liquid futures market and also a futures options market that is liquid. The same is true for some of the agricultural markets. The same is true to an extent for the S&P 500. But then doing this stuff in coffee, cocoa, sugar, yeah, fine, but not as easy. You also have to be careful about these options, like nat gas, for instance, has European and American options, and depending on where you are, summer, winter, the Europeans are more liquid than the Americans, and then it flips around. Some strikes are more liquid than the others. I look at all of that stuff, and then the kind of like when you do it in the bond markets, bond futures, you don't have the long dated futures curve because everything is concentrated in the front quarter liquidity. That's the only thing that matters. It's not a commodity like a physical thing. It's a financial instrument. And so yeah, right now it's deck 23 is the bond and the equity index contracts and the FX contracts, and nobody cares about March 24, even though the CME has that contract listed. It may have a few lots of open interest, but nobody really goes there because why would you? All the liquidity is still in December, and that is also then true for the options, which means that I can't really do these trades long dated, and I don't like that. Because if I can't go relatively long dated, then that means I have a lot of gamma. I have a lot of time decay potentially, and I have a very fast moving option, which I try to stay away from.
So an absolute layman's way of thinking about it is you're still hunting outliers, but just with a bigger gun, essentially. Right. I mean, you're bringing more ammo by using this replacement, this option replacement strategy.
Yeah, that's in a way, that's right.
I have another next week. It's a webinar. There's a lot of stuff on Twitter, so check my Twitter. It's with it's going to be pretty interesting. I'm going to have to really behave myself. And I've been practicing. Corey Hofstein and Bob Elliott, I think is his name. Can't remember. Myself, and I will be 7 a.m. here when I'm still in Australia. And it's going to be a webinar. Yeah.
I cannot wait for that.
15th. 15th? I think it's the 15th. It's hard, a little messed up as well. So yeah, the we've got to talk about how we trade with all the stocks, and of course, yeah, Bob Elliott, and I'm more familiar with his replication styles, and then overlaying the managed futures strategy with on top of 100% allocation to bonds or 100% allocation to stocks. He has both. And, as I've said before, recently I've sort of figured that my stock portfolio is not that correlated. It's not very correlated to the S&P. So I think that I'm not going to compete with those guys necessarily. If someone really wants the S&P stocks and then they have to go this route, or someone like Eric as well. And then of course, when you have a big trend following fail, a V bottom or a crash like COVID, where the trend following stocks would be subject to that V bottom again and the rally. I don't really think that I'm solving the problem that some people, I guess what I'm more trying to do in my own way, I'd like to be more like Florin Court, but in my way, with using a lot of the stocks, I reduce the number of markets and make trend following better with more markets and more diversification. And it's still going to be subject to any sort of issues that trend following may have, especially as it relates to stocks. So it should be an interesting discussion. And so if you guys have any suggestions on questions or things you want to hear talked about on that, just send me a message and we'll just hopefully I'll be awake and be able to be coherent.
Jerry, sorry, one more time, the date. The date of that. Sorry, I want to make sure I hear it.
Yeah, I think it's the 14th.
Okay, cool.
4 o'clock Eastern time, 4 p.m. November 14th. So I think you have to sign up. Oh yeah, you have to sign up for that. Like I said, it's all over my Twitter. I posted it a bunch of times. And then I think they're going to record it as well. Yeah, definitely.
Well, be nice to Corey if you're able.
I know. I will. I'm trying to think if I have any reason not to be, which I don't think I do. So, yeah, I like those products. Here's Woody. I'm an investor. So, you got to be nice to me. I'm an investor. Yeah.
So true.
And now, Jerry, how are you holding up? It's well past 11 o'clock, well past your bedtime. This is what I have to do on Spaces each week with you. So how are you holding up down here? Now you're sort of the shoes on the other foot.
Yeah, seriously, the bird is asleep already. I can't hear him.
Oh, I don't have a bird. I'm in Australia, so I don't have my bird.
I know.
You
don't even bring the bird.
Sightseeing. Yeah, I've been looking for birds. Been bird watching, I guess, what you call it. So yeah, I've been doing that here. That's been fun. We saw a lot of.
You must be exhausted, Jerry. All that walking today. How are you holding up? You sound as though you're exhausted.
It was worse. It was worse than that. I mean, that was over with by 12. So yeah, we got an early start. I had a hard time sleeping last night, but I feel good now. It's only, yeah, it's a little late. But yeah, it, I'm doing fine. I mean, it goes. I feel like I have on some days I will swear that I've kicked the jet lag, and then yesterday I woke up at 2 a.m., couldn't go back to sleep, did a big huge hike. But then I was falling asleep right before this spaces, but I forced myself to get up, and then you and Oleg made me start laughing, and so I'm completely awake now. I'm going to get back into the book shortly, but I don't think we'll go full 2 hours today, but we're an hour and 20 minutes in, which is pretty darn good.
Jerry, I'd like to ask a technical question for my ATR purposes. I'm so hung up. Loose pants, Josh. Relax. Step away from the ledge. Okay. Since I've had my single stock experiment in trend following using Robinhood with single dollar fractional entries each night, looking at 6,500 common stocks and the ADRs, I think they're called, and unit trust things. I've moved from a stop loss of 3 ATR to 4 to 5 to now 6, and now I'm playing with 7. Why? Because I just hate getting stopped out of something at $30, only to get back into it a few months later at 45. I'm like, I missed that whole run up. So I think I just need to take that extra digit, that extra step to 7 ATRs. And by ATR, I mean a 14-day average calculated, whatever that funny fun formula is, 3, the highest of the 3, whatever's. So anyone want to say anything, Jerry, about the leap from 6 ATR to 7 ATR? I think I'll be happier.
I don't think you will be. No, I mean, I think those are good numbers. Okay. All the numbers, I like them. They're good. But it's just going to happen. And, one thing you said, which is months later, I'm buying it at 45. Look, so many people are using a small ATR and they're out, they buy on Monday and they're out on Monday afternoon. And then they got to get back in on Tuesday. And I used to sort of trade that. So, mere fact that you're saying, oh, a month later, and now I got to buy 45. No, you're way ahead of the game. And that is rare, I think. But it can definitely happen. And you're not always getting out of these things with those size ATRs right at the low. It's going much, much lower after. And I never even think about that second buy, the initial one's at 30, the next one maybe 45 because it ran up to 45 while you owned it. And then then you got stopped out from your entry of 30. I don't really, what does bum me out is just all the years I traded when I wasn't trading an optimal stop loss. It was more of a way too short term and built up commissions and slippage. And then you're frequently continuing to buy higher prices, multiple times during the same week, possibly. So that's just something that really would bum me out. But buying at 30, getting out, and then waiting a month or two later and getting back in, that's it's not going to get any better than that. So if you didn't like 6, you're going to be disappointed in 7. But I think just the problem is you shouldn't be disappointed. You're doing the right thing. You're going to have these issues, and I think those levels are more optimal than something a lot smaller. So good job on that.
Thanks. I almost quit. I almost just sold the whole load and went to the professionals. But I'm like, you know what? There's no one I know who's offering me a product of 6,500 retail common stocks I didn't personally trend follow. Now, maybe the people who created what's that called? TFPN? It's an ETF. TFPN, I think it stands for Turtles for Power Now. Anyway, I think the creators of that ETF are looking at a whole stock market trend following product, but I might be dreaming that. Thanks.
We'll have to check that out. No, I think that's good. I think it's good. I think it's probably unnecessary to trade all of those, but I know, I do continue to trade because it is fun, and yeah, you want to have some fun and get into it and enjoy it, for sure. So keep going, don't stop. Add some other markets, or not. You probably don't even need to. Yeah, probably don't even need to. My stocks are so different. They just act so different. They're really like commodities almost. They're
Right.
not even. You throw trend following on top, and you've got longs and shorts and flats. And on up days, you're getting out a bunch of stocks. On down days, you're buying new stocks. So, yeah, it's really, And then on really bad days, all my stocks are down, and vice versa. But it's definitely a lot of liquidity, a lot of diversification, and it's fun to see some outliers. We get a fair amount of fun outliers on trading these stocks.
Well, I'm fascinated by the whole notion of return stacking. I have to admit, although I'm a bigger fan of just the old school, straight up trend following. So, but that being said, again, looking forward to that combo. Maybe Rich, you could break down the discussion on the algorithmic advantage. Moritz, you were great on there, so I've been enjoying that.
We'll give it a shot, Woody.
I mean, it seems to me that obviously from a business point of view, that there's a lot of people out there who are never going to get rid of their long equities. They're not going to really trade them too much or do value, and they're going to be doing the opposite trades that I would do with their stocks, and they're not going to get rid of their stocks and bonds. And so this is a good way for the people like that who want also some alternatives. It's one-stop shopping, and I think that's a good product. It's much different than what we do, and I do think that trend following a lot of different stocks is a good idea. I was thinking, in this article that I read today from CFM on the Financial Times, and I tweeted it. He says, I didn't tweet this part. He said something like, we reduced our stock exposure in the trend following fund. We don't trade as many equities or maybe any equities for some clients who want business alpha and futures crisis alpha. So we don't even trade equities for those people at all. And I was thinking, because when the stocks crash, we don't want to be long stocks. We're adding to this problem that we're telling people we're going to help them solve, which the world revolves around bonds, stocks and bonds. And so we're just here to help those things out. And I was just thinking, what a miss, a miss if I didn't have stocks, during the good periods, I would have missed so many good trends. The lessening of the diversification would make the program worse. And then I have so many shorts on now, and my shorts are so superior to trading indices. I've got so many over 100 shorts, and they're not that correlated to each other. I've been putting them on over the last 6 to 9 months, getting shorter, then buying some back, and so sometimes I come in and some of the stocks have just crashed. They've had some bad earnings or whatever, and so taking stocks out of my portfolio would just make it such a worse product. And on the upside, and then the hedge I can come into, unless the stocks crash from an all-time high, probably going to come in with a fair amount of shorts on. So I think you just miss a lot of good opportunities and obviously ways to protect a stock and bond portfolio if you're not trend following stocks as well, long and short, because the trend following really does make a difference. And, like I said, I've tried the failure of the trend following of stocks. It's failed dramatically a bunch of times, especially recently, COVID, and other times where you just get these V bottoms. And as soon as we get short, the market just kind of rallies. So, but it is still worth having in there. You want to have all of those markets in there because trend following will kind of make them not look like the S&P and the stocks themselves. Everyone thinks stocks are incredibly correlated, but they are sometimes. But most of the time, they're not. Oh, Covell, we can end on this, but I thought it was Covell posted a tweet where someone was saying they're not going to trade feeder cattle anymore because they don't eat meat. And I thought that was, so I don't eat a lot of meat either. I still trade feeder cattle. My point was, I would definitely take feeder cattle out of my portfolio, not for that reason, but because of this last trade. And posted a chart. This is like the worst chart ever. If you go and look at that tweet, it's a pretty nice profit, and I held on to it way too long, and it just turned into like a loss. And I was like totally shocked by this. Oh, same thing happened when I was short the ruble back during COVID. I probably was the only profits in the ruble and gave them all back. And it's happened to me a lot. But this is the problem with optimizing for the length of the back of the breakout, trading these loose pants breakouts that are really over all the trades, all the data, they do really well. But boy, you can really pick out some horrible trades that you're kind of embarrassed by. And this feeder cattle, it's just one of them. But if that's the lesson of systems and trend following is, we're always willing to sacrifice. If we're not willing to give all of that money back in feeder cattle, then we're not going to hit those, we're not going to optimize those outliers because that's what it takes to get Eli Lilly and OJ, sugar, cocoa. So that's the problem. That's why there's so much emphasis put on fall management, correlation management, any kind of management that helps me get out of that feeder cattle before all that profit, that beautiful profit, was not super duper big, but still, it's embarrassing.
It's just so obviously catering to the human kind of cognitive bias to the mental accounting. It's it's like chapter 3 in Kahneman's book. It's just a mental fallacy. It's crazy, but it doesn't matter what you paid for it. Thanks, Jerry, for pushing through despite the obvious fatigue. I always enjoy listening, so I'm gonna head out. But pleasure talking to you guys.
Yeah, everybody. Thanks for being here, everybody. Sorry I can't go another 30 minutes, but I think it's a good time to call it a night. And I'll be doing the same, probably, for sure. I'll be in Sydney and round 2 from Australia next week. So we'll see you then. Have a good weekend.